Hi, this is Mike Swanson again. This is part 3 on my series about bear markets. You might want to go, if you haven't, listen to the ones before it, and the ones after it will be following in the next couple of days. What I'm going to talk about in this segment is the reasons or the origins or the causes of this bear market that we're in. They're fundamental economic reasons, and you can talk about high oil prices now pitching consumers and credit card debt, people losing their jobs and this kind of things. But when you get down to it, the real cause of this recession is real estate. The real estate market began to decline ahead of some people losing their jobs, and even ahead of this craze in oil prices, which I believe is being driven by the Fed lowering interest rates and simply printing money to stimulate the economy. At the moment, there simply aren't enough good places for this money to flow into, so it's flowing into commodities and driving oil up. And the dollar, of course, is declining in value, which is also driving oil prices up for those of us in the United States. But again, to get back to what I really want to talk to you about, it's real estate. It's the decline in real estate that's causing this bear market and this economic downturn that we're in. How long is it going to last? Well, again, the key to answering that is studying real estate. And back in September, I wrote an article on my website and did variations of this theme 2 or 3 times that were picked up by other websites. In fact, Business Week, the magazine Business Week, carried an article that I wrote about what I'm going to tell you. Now, if you remember back in August, the market took a nasty dive that was really scary at the time for a couple of days. The Fed started to intervene. It cut the discount window. In the middle of September, it lowered rates of, was it 50 or 75 points? Well, either way, it was a whole lot. And since then, of course, we are where we are now. Well, after that August emergency action by the Fed, one of the Fed governors, Fred Miskin, did a study about real estate. And you have to realize Miskin is Rudy Bernanke's right-hand man. They were colleagues together in college. They've been best friends, or close friends at least, since their mid-20s. And Bernanke brought him onto the Fed with him. So he told him, I need you to commission this study for me. You're my guy. So he goes out and does it. He gets the most priority marching orders from Bernanke. They tend to think alike too when it comes to monetary policy and what they believe needs to be done. So anyway, he commissioned a study about real estate, and what the study does, it projects what will happen to the economy and in the stock market and everything if real estate declines by 20% in the 12 biggest cities in the United States. Now, what you should do when this video is over is go find my article, and it'll reference the study so you can go read it for yourself, because you need to have the facts and knowledge to deal with today's environment. So when this is done, go to Google and type in Fred, I don't think you type his first name, type Miskin study, Mike Swanson, in Business Week, and you'll find the article to it, probably a couple articles. If you don't type Business Week, you'll probably find half a dozen articles or maybe even more picked up by me by different websites. So you'll be able to find the article that goes to this study and read it. Now, the thing is, a 20% decline in interest rates in what he projected was a recession that will last through 2010. And they did different scenarios of what the Fed should deal with it. One scenario is that the Fed do what it normally does and lower interest rates in a gradual manner as the economy slows down. Because, actually recessions aren't fun, but they clean the excesses and prepare the way for the next boom. So they're kind of like a natural part of the business cycle. I mean, you don't have a business cycle without booms and recessions. But anyway, in this study, he advocates lowering interest rates within a 4 to 5 month period really rapidly, more rapidly than the Federal Reserve has ever done. And the study claims that if you do this, that the recession won't end before 2010, but the first half of it won't be so bad. It'll, the trough will be at a lower point. There'll be less unemployment. The stock market won't fall as much. Real estate won't fall as much. But a side problem is you will have more inflation, and that's certainly what we're starting to see now. Now, the big question is, are we going to get a 20% decline in real estate from its peak value in the 12 major cities in the United States? And secondly, when is the decline in real estate going to end? Because it's my view that when the decline in real estate ends is when we'll see the trough in this downturn, recessionary part of the economy, or this, trough in this business cycle here. In the stock market, historically bottoms are about 6 months before that. Well, you can find that out. There's the most accurate indicator of real estate prices is futures contracts that trade against something called the Shiller Real Estate Home Index, which is an index of the value of real estate for the 12 biggest real estate markets in the United States. Now, what happens is these future contracts people are the most accurate predictor of what real estate's going to do, because they're putting their actual money on the line and making their predictions. They're not simply real estate lobby groups predicting bottoms or whatever. These are people with real money on the line, and what they projecting right now is through February of 2009 a 27% decline in these 12 biggest markets from the peak of the other year in real estate prices. So we're going to exceed that 20% point that the Miskin study was based on. And the interesting thing is the decline pretty much is very steep from now until about February, but then it starts to level off and slow up. So you can see a good possibility that the real estate prices will begin a bottoming process next year. And the consensus from the experts I think are listening to, and I'm not pretending to be an expert on real estate. I'm just going by stuff I read, the people who I think are knowledgeable experts on real estate. They're projecting a bottom sometime late summer 2009, maybe in the fall. And if you look at these futures contracts, they seem to be pointing to the same thing. Well, that's correct. That means we can expect to see a bottom in the stock market, a true bottom, not simply a bottom like we saw in March, but a true bottom sometime in the first quarter of 2009. So between now and then, you need to pretty much be willing to accept reality that this is a bear market and adjust your investment positions accordingly. In the next video, I'm going to talk about the psychology of a bear market, because it's very difficult for people to do this, even if they listen to what I've said so far and believe me and do the research and look these things up to verify them. And for the futures contracts for real estate, and more good resources on projections for real estate and the real estate market, there's a website called I believe it's papereconomy.com. It might be paperdinero.com. If neither one of those load up, go to the Google search engine, type paper economy real estate, and you'll get to it. And when you get to that website, it looks like a blog, and on the right sidebar there's a thing, I think it says tools, and you'll see this a place to see these futures contracts and the Shiller Price Index. It also has great data in the inventory of the major markets in the United States. You can even look at your own real estate market and see what's been happening to the value of the homes around you. So definitely check out that website, and then be looking for my next video, and we'll talk some more about this bear market.